Disney reports earnings before the market opens on Wednesday, and results are going to be really interesting because this is a company that is very, very unloved by the market. Investors don't think a lot about their direct-to-consumer business. Obviously, cable is dying in a lot of ways, but I think there's going to be a number of points of strength to look for. And if that's the case, not only is the company's revenue and earnings going to grow long-term, and I think this is a 5 to 10 year story at least, visible for Disney, I think not only are those fundamentals going to get better, but also the market's multiple that investors are willing to pay is going to get better. That gives a ton of upside to the stock. So I want to dig through exactly what I'm looking for tomorrow. The two big things are going to be parks and experiences, and then also the direct-to-consumer business. Is there momentum in not only Disney Plus, but their bundles, and then moving ESPN over the top in 2025. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to look at fiscal second quarter results to try to put what I'm looking for into context. And I'm going to put some charts on top of this as well. This is a look at last quarter's results. You can see that parks were growing across the board. Domestic parks is in blue, international parks and experiences is in green, and then actually they include consumer products as well. So that was flat, but the opening of the Shanghai park was one of the tailwinds in the quarter. There was increased pricing in some of the domestic parks. That's something that I think Disney is kind of trying to balance. And this is an area where they're investing $60 billion over the next 10 years to expand parks. But let's look at this in a little bit broader context. This chart shows quarterly revenue in blue for the experiences segment, and then in orange you have experiences operating income. So this is actually the most profitable segment for Disney overall. If the company's net income goes up, it's likely going to be driven by the experiences business. Now, don't be surprised if there is a little bit of pressure on this business. We have heard a lot in conference calls and in earnings reports that consumers are starting to pull back a little bit. So Disney is going to be one of those experiences that people are going to, one, plan ahead of time, and two, maybe spend a little bit outside of what they normally would on something like a regular vacation. But I wouldn't be surprised to see some weakness. We had a massive buildup coming out of the pandemic. People were chomping at the bit to go out and do something, especially with families. And Disney was one of the major beneficiaries for that. So don't be surprised if this kind of pulls back to a more normalized number and still is a phenomenal business. So I'd love to see continued growth. But again, I'm not going to be surprised if there's a little bit of weakness. On the entertainment side, they break this out down into linear networks in blue, direct-to-consumer in green. This is always one thing I think we really need to understand as investors, that the direct-to-consumer business, the streaming business, generates far more revenue than the traditional linear TV business. So if they can get those margins up to 20, 30% long-term, this could be a much, much bigger business than linear TV ever was. The challenge is that operating income has been on the decline for linear networks, and it is just barely back to break even for direct-to-consumer. You can see that this is the direct-to-consumer operating losses and then moving to a slight operating profit. So this was one of the focuses when Bob Iger came back, was to get this back to profitability. The hope here is this moves to a significant profit in the fiscal third quarter of 2024. What would drive that? One is going to be the subscriber number. So Disney domestic subscribers and international subscribers, these are the core businesses. Basically, you pull out the Disney India business, Hotstar, not a lot of revenue coming from there. They have given a little bit on price in some of these areas to increase the subscriber number. So don't be surprised if you see that. Disney is pushing more and more to ad-supported tiers. They're also bundling more. So if those bundles are successful, that's going to be more subscribers on the service, but maybe coming in at a lower price point. So that's definitely what I'm expecting, is this ARPU number to come down, but the number of subscribers to go up in the quarter. Hulu is likely going to be the same thing because Hulu is now more and more bundled with Disney Plus. And if those bundles are successful, you're going to bring down your revenue per average user, but you're also going to reduce your churn, which is going to help keep those customers long-term. It's going to be a much higher margin for you because customer acquisition cost is a huge challenge for streaming services. Sports is going to be something that I also am going to keep an eye on because ESPN is supposedly going to get a tile in the Disney Plus app by the end of this year. The big upside for ESPN is going to be in 2025 when that does go over the top with their streaming service. They're going to have NBA rights. There's going to be really a completely new service for ESPN, more than their traditional channel, much more like a streaming service, probably a lot more like Peacock that you see today with the Olympics. And that's going to be included in a lot of those bundles as well. So again, this is going to be part of the bundle strategy. We don't know what the pricing of ESPN over the top is going to be, but early indications with their new bundle is that it's going to be a pretty high price point. So look for a little bit more discussion there, maybe not all details, but if this continues to be solidly profitable, that would be a good sign heading into that streaming business in 2025. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. If we do see the experiences business really start to be a baseline for Disney, just a business is going to churn out cash flow quarter after quarter. And then the growth comes from the direct to consumer business, which I think still has a ton of runway to not only add subscribers, but also increase the revenue per subscriber long term, not only from bundling with current offerings, but then adding in ESPN in the future. If those two things hold true, I think Disney stock looks pretty attractive from a valuation perspective. Now, this chart shows the valuation numbers as they're reported today. The price earnings multiple of 95 looks extremely expensive, but remember that the direct-to-consumer business was reporting losses until last quarter, so that should turn around relatively rapidly as they lap some of those losses, and those losses turn into profits in future quarters. The other thing is there was a $2 billion restructuring charge last quarter, so there are some one-time expenses that are included in that. But if you look at the price to sales multiple under 2, the enterprise value to EBITDA, which is a proxy for cash flow coming from the business, is under 13. I think those are pretty reasonable valuations. There are also some other tailwinds for the business. The movie business is finally starting to turn around. We saw that with Inside Out 2 earlier this summer. Deadpool and Wolverine was an obvious hit. Both of those movies are going to do well over $1 billion at the box office. And there's another couple movies that may do over $1 billion in box office coming later this year. So that should turn the studio business around a little bit, maybe generate a little bit more profit from just making movies. And then also that ultimately fuels the direct-to-consumer business, and then even eventually the experiences business. So you add all of these things together, I think Disney's business is trending in the right direction. The valuation looks really attractive. So you add those two things together, and I think that could really fuel the stock over the next 5 to 10 years. Disney has typically gone through these huge cycles where they kind of go from boom to bust. So you had the Walt Disney era, and then they went through a bust era, and then you had the Michael Eisner era, particularly in the late 80s and early 90s. And then you kind of had a bust time, and then Bob Iger came in, and there was a boom time when they acquired Pixar and Marvel. And then there was a bit of a bust period, and I think we're coming out of that now. The creativity is starting to be infused back into some of the studios. The direct-to-consumer business is really starting to hold its own, and is a clear number 2 to Netflix right now in that business. And I think there's only going to be 1 or 2 winners in the streaming business. Disney has a chance to be one of those, and if they are, this is going to be a much more valuable company in the future. But let me know what you're looking for in the quarter. Put those comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.